Hey, good morning. Hi,
Morning.
Ron.
Hi, Kath. How are you?
Oh, I'm good. Welcome to season two of the Baby Boomer Investing Show, everyone.
Yeah,
Uh, we've got a lot to go over. It's been a great run, hasn't it, Ron?
it's been a lot of fun, and I think we've created some really good stuff. I hope people will watch it. But in the meantime, after season one, you've made a great move to Las Cruces.
I have.
Yeah,
And hey, everybody, look at our studio back here. This
very
is
nice.
great. And I have to let you know, little disclaimer up front. If you hear any dogs, it's because we do the Dog Connection show too. So there are dogs in the background. And Ron said he was okay with that.
I like dogs.
Yeah, yeah,
Yeah, you got a new chair, your Starship Enterprise
I
chair.
know. This is Queen Kathleen.
Very cool.
This is Queen
We,
Kathleen.
we
Looks
can
good.
worship the Queen.
Yes, you're
Yeah,
what you may kiss my ring. If I
absolutely.
had one on, I don't have one
Yeah.
on. Yeah.
So we're starting season two, and we have a pretty aggressive agenda for today. If you want to do the first slide, Kath.
Okay.
And the agenda is looking into the future, and it's something I normally don't do, but under the conditions that we are at today, I think it's important. So we're going to do that. But before we launch into the new season, I'd like to recap the old season. So on
Okay.
the next slide, and season one was 15 episodes. 9 of those were about investing, and it's the Baby Boomer Investing Show. Um, 7 of those were pretty much the same theme, and we're going to do the same theme throughout season two. And that is this: it's really simple. It From all the surveys that are being done, it looks like baby boomers are investing about 60% in equities and 40% in bonds. And we've been saying for the whole season, we're going to do it in season two, that that's too much risk for baby boomers for where they are in life right now. They are in what's called the risk zone, which is the 5 to 10 years before and after retirement. And losing money in that risk zone can totally ruin your retirement. And you only get to do that once.
Yeah.
So that's been our theme. 2 of the other episodes that I really like a lot. One was the 70-year evolution of investment consulting. And that's an article now that's going to be published in the fall. And also on the Investment Consultants Association, they're going to run a series on the evolution. So that's turned out to be a hit. And then one that I thought was fun was about boomer lifestyles. And you might call that rich man, poor man. There are rich boomers and there are poor boomers. And we talked about how they're living right now. Sort of a look into the lifestyles of the rich and poor. Then I'd like to thank our guests from season one. And we've done, I think, some really good topics that are not necessarily about investing, but very important. So we had Gwen Sherrick Elberson, guest host with us on Medicare. Elaine Floyd from Horse's Mouth on Social Security. Tony Sebra from UBS on reverse mortgages. L. Smith, that's all L does is help old people get a job. So that was really cool. And then Steve Zuskin on smart spending, and Larry Siegel on humanity. So we have all those shows there, and they're available for you now. So please watch them. Tell your friends. And season one is now done, so we're going to move on to season two. And the topic now on the next slide, Kath. The tectonic plates are shifting, and so they're shifting for the stock market. They're shifting for the economy, and most importantly, up until the last 4 days, they have been shifting apart rather than together. And I'm not the only one saying that. There's been headlines like that over on the right. Reuters recently published an article about the opening gap between markets and COVID-19. Now, when I was preparing for this show, that would have totally been true. But in the last 4 days, the Dow has lost 1,000 points. So we think,
Wow.
and
Really?
maybe that's just the beginning, maybe not. We're going to talk about that. But one thing is for sure, that we're in Southern California, and there will be earthquakes, and there will be tectonic plate shifting, and they are indeed doing that. So I'm going to talk about these independently. First, I'm going to talk about the economy, and there are threats to the economy, and one of those threats actually is the stock market. So I'm going to throw something out there that I thought I might say later, but I'm going to say it now. When the Great Depression occurred, Dr. Robert Haugen, well, after that, but he wrote a book. And the belief was that the stock market forecast the Great Depression of 1929. And his book basically says that the stock market crash of 1929 caused the Great Depression. And that's a big difference. So in terms of threats to the economy, I'm going to talk about the ones, COVID and everything else, but the stock market really is a threat. So the next slide, Kath. So I'm going to separate these out, and there is a global economic crisis, and it's not just COVID. There are other things going on globally. In particular, there's a debt crisis that has been going on for a while that is really problematic. So I'm talking about economic struggles first, and then go on to the stock market. And on the next slide, I'm going to do these pretty quickly. The economy is in a recession, and the recession is lower employment and also a slowdown in the economy. And before I forget, I'm going to try something new on this premiere episode of season 2. I'm going to give viewers homework, and I'm going to give you 4 assignments as we go through this. So stay tuned, and if you can, please have a piece of paper and pencil around so you can write down your assignment. And when you do it, please feel free to reach out to us and tell us what you found, because I think you'll.
What if I don't have a pencil?
Well, then you're just going to have to memorize. Or do
Could I use a pen?
You could do a pen. Yeah. Okay.
Could I use my telephone? My cell phone?
You could enter it into your phone. Sure.
There. Okay.
So you have all these choices.
Yeah. There you go.
It's amazing. So just to recap on unemployment, on the next slide. When the pandemic was first recognized as being a pandemic, basically in February of this year, the unemployment rate skyrocketed to about 15%. And it's been improving, so that's been really good. And every little bit of improvement here seems to be the news that is bringing the stock market to new highs. So that the stock market is just hungry for anything that reinforces the idea of buying more stocks. In terms of gross domestic product, on the next slide, Kath. The first quarter, the headline said gross domestic product is down 35%. And the weird thing about that is, I don't know why the customary reporting of changes in gross domestic product are annualized, but that 35% is an annualized 7%. Since March, as of the end of July, the gross domestic product had fallen by 10%. Now, the 10% is a important number because economists defined a recession as a decline in growth of 10% or more. So we officially reached the recession in July. The other thing I want to point out on this picture is we have been saying that it's been a booming economy. And I think politicians in particular say we've had a booming economy. If you look at those bars, for the last 4 years, the economy has been growing at about 2 to 2.5% per year. That's not booming. For contrast, China has been growing at more than 6% per year. So 2.5% is better than something less than that, but it's certainly not booming. And that fact is going to enter into our conversation about the markets. But what I want to share with you is there's more to the economic stress than just unemployment and GDP growth. And the next slide, please, Kath. So Paul Harvey was somebody I really loved his voice. I mean, he just listened to him all day long. And his catchphrase was, "And now you know the rest of the story."
Yeah.
So I want to tell you the rest of the story. And it starts on the next page. And here's your first assignment. So get your pen and paper ready, or your pencil or your phone or whatever you want to get ready. So what I'm showing you here is actually taken from work by a professor at Boston University. His name is Lawrence Kotlikoff, and it's spelled Kotlikoff, Kotlikoff. Likoff. And your assignment is to Google Lawrence and read his materials. He's written a lot. But what he's really been doing is screaming to everybody who will listen that the concerns about our debt are totally understated. And in the graph here, our current gross domestic product is around 21 trillion. And the debt that most people talk about is around 27 trillion. So that's more than 100% of GDP, and certainly something to be concerned about. But Dr. Kotlikoff says that's the balance sheet debt. We have serious off-balance sheet debt. And we call that Social Security, and we call that Medicare.
Ooh.
Social Security debt is in, you can see the details in the table above, but it's around 29 trillion. So that's even more than the balance sheet debt. And Medicare is around 47 trillion. If we add all of those together, you get about $100 trillion, which is about 5 times GDP, 500% of GDP.
Wow. Wow.
So
that's scary. That's very scary.
We owe a lot of money, and the political will to do something. So Social Security is supposed to go bankrupt. Originally, it's supposed to be 2034, but now they're saying with COVID, it's probably sometime in this decade. And by broke, it means that the funds that are set aside. So in 2018 was the first year where receipts for Social Security, basically taxes, were not sufficient to pay the benefits. So for 2 years now, we've been digging into Social Security savings. Then Medicare is supposed to go broke in 2026. Now, the thing that happens when you start saying going broke is people say, hey, anybody who can print money can't go broke. And that leads to the next slide, Kath, which is just overwhelming. And that is not just the US, but the entire world is in a debt crisis. And the monies that are owed worldwide exceed 500% of GDP. It's 500% of GDP for sure here in the US. Another way to put that into context is on a per capita basis. Everyone in the world owes around $200,000 in US dollars.
I don't.
Well, that's because you sent yours in. I remember that.
Yeah. Okay.
Yeah. And you got a nice letter from everybody thanking you. So
yeah, right. Yeah.
You did your part. But that world debt thing is manifesting itself in a variety of ways, and it's shown all around the circle here. Your next assignment is to look up the word. You may think you know it, but look it up. It's called monetizing the debt. Monetizing. And it is what we are currently doing to print money. So when people say we're printing money, someone else will go, no, we're not printing money, we're monetizing. And they would be right, we're monetizing. But what does monetizing mean? Well, monetizing means that the Treasury borrows money. So when you all on this call got your relief check, it said U.S. Treasury on it. The U.S. Treasury wrote that check for you. Hi, Dale.
Hi, Dale.
So the Treasury can't just print money. It has to borrow it. And the borrowers have dried up. U.S. citizens right now can't lend more money to the Treasury. They're having trouble paying their bills. Foreign citizens can't do it either. They're having their own problems. So foreign governments can't do it. So the entity right now that is lending the money to the Treasury, you ready for this? It's the Federal Reserve.
Wow.
So we're taking money out of one pocket and putting it in the other pocket.
That's like paying Peter. What is that? Paying to pay Paul?
Right.
Borrowing from Peter or stealing from Peter? Or
borrowing from Peter to pay Paul. That's basically what it is. What happens there is it's like printing money, that money got into the economy originally with quantitative easing. And the amazing thing was, and by the way, if the Fed did not do this in the Treasury in 2007, 2008, um, the gears were locking on the economy, and the economy would have come to a total halt. Things would have frozen. It would have been as ugly as all hell. And this notion of just throwing money at it was sort of justified by this relatively new economics branch called modern monetary theory. And modern monetary theory basically says the government should, if you can print money, you should use it to calm down an economy that's suffering, that's stalling. And part of that, in my mind, and I know economists would disagree with me, but I think that's basically saying you throw money at it, people will suffer from money illusion. So there's now more dollars in the economy, and that should cause inflation. But they said it might not cause inflation. And lo and behold, that $5 trillion that went in over time from quantitative easing, there was very little inflation. So how can that be? There's more dollars, same amount of goods, but prices didn't go up. Well, what happened, and this is a hard sort of path to follow, but most of that money went into the stock and bond markets. It went into the bond markets to keep interest rates artificially low. It went into the hands of people who are selling bonds, and they bought stocks. And what really has happened here is we have had inflation, but it's been in the stock and bond markets. So a big part of the reason why the last decade has been so great for the stock market has been the federal intervention, putting quantitative money that mostly found its way into stocks and bonds. Now, with the COVID relief, the Fed put another $3 trillion into the economy, and some of that's going to be used to buy groceries. So now I think we're going to see the regular measure of inflation, basically the consumer price index, the CPI, start to increase. And there's likely to be another $2 trillion in COVID relief. Again, that's probably likely to move the CPI needle as well. Now, here's the thing about modern monetary theory. And I think I've got this right, but I'm certainly not an expert in this monetary theory. But
well, just ask me. I know.
Yeah, I know you know it, but
yeah.
I think
what my 2 cents.
Yeah, thanks. I think that what's supposed to happen is the government is supposed to watch, and if inflation starts to rear up, that money is supposed to be taken back out of the economy. Now, how do you take money back out of the economy? Well, you tax it. So taxes are the mechanism. And what's going on here now is federal Treasury Jerome Powell, has recently said to the world, don't worry, we're going to keep interest rates low. But don't be surprised if inflation rises. Now, I think what that means is the Fed doesn't control taxes. They can print money, they can do all that, and that can certainly alleviate some of the concerns. But if inflation does start to rear up, they have no control over what Congress decides on terms of undoing that and raising taxes. So I think they're really saying, expect inflation. We're going to keep interest rates low because we got the money to do that. And what you're going to see is what people call negative real interest rates. And that happens when interest rates are less than inflation. So if the interest rate stays at 0.5% and inflation's at 2%, the real interest rate is a negative 1.5%. So I don't know who's doing this 55 plus communities thing, but commodities are a fairly good idea to protect against inflation, especially the CPI measure, because most of the consumer price index is about commodity prices. So we have this debt crisis, and there's more. So let's go to the rest of the story on the next slide.
Okay.
So we know COVID-19. And by the way, when COVID-19 first came on the scene, there were a lot of people who were stock market observers saying there's got to be a correction in the stock market. It's way overpriced. And when COVID-19 struck, and everybody's saying there's got to be a catalyst. What's the catalyst going to be? We go, wow, COVID-19, that's going to do it. We're going to clear the market, and the prices are going to adjust back. But we're going to talk about that. They've rebounded. There is a stock and bond market bill we're going to talk about. World debt is very high, but the other dangers have not gone away, and they may not for a long time. We still have the threats of nuclear powers. A dirty bomb could still go off somewhere in the United States.
Mm-hmm.
The trade wars with China have certainly escalated, given that they are the source of the virus. So I think there's some American condoning going on. Let's get those guys back. They're making us sick. They're making us die. So trade wars are never good. Yep, retaliation. Hyperinflation. Now I'm going to give you your next two assignments here. So one is to Skype and find a service called Peak, P-E-A-K, Prosperity, Prosperity. And they have been running, I get mine once a week. They may do it more often, but it's a free publication. And it talks about what's going on in the economy, good and bad, but they're not watering down the news in any way. So if you want the real story, I think Peak Prosperity is a good source. And then the other thing to look up about trade wars is Smoot Hawley. It's S-M-O-O-T Hawley, Hawley. So that's our third and fourth assignment. Smoot Hawley was an act that was passed in 1930 in the throes of the Great Depression. And it was designed to isolate the U.S. from the rest of the world. It was protectionist. And the effects of that, from most people's opinions, really aggravated the Great Depression and probably made it last a few years longer. So that was all bad. Then the last thing that's going on in addition to, so to get the whole rest of the story, and we all see this every night, it's on the next slide, Kath. We are having, I love it when the news says there's protests. When
they're peaceful.
Yeah, well, when they're peaceful, they are protests. When they're riots, they're riots.
Yeah, right, yeah, right.
So I'm pretty sure what's going on there is quantitative easing really did cause a big divide between the rich and the poor. And I think the poor people, are going, hey, we can get some free stuff. Let's go in there and break a window and put a TV on.
And there are no repercussions.
It seems not.
Yeah.
Yeah. So that's scary. And I feel sad for the people who live in Portland and Seattle and Chicago.
Mm-hmm. Our hometown.
Yeah, we used to live in Chicago. But I think the stuff in Chicago is isolated still to the south side. But
yeah.
Anyway, so that's the economy is in real trouble, and hopes that it's going to recover, I hope come true. But there's a lot of reason to think it's not going to. So let's switch gears now, Kath, and go to the stock market.
Okay.
And the bubble is probably going to burst. And I want to talk about, first of all, who says it's a bubble? What makes it a bubble? And then I do this thing that this graphic here is it's called the FANG stocks, and it's Facebook, Apple, Amazon, Network, and Google.
Netflix, right?
Netflix. Did I say what did I say?
You said network.
Oh, Netflix. Yeah, thank you. Yeah, it's just Netflix. Those 5 stocks have been growing like crazy. They are 23% of one of the benchmarks that is widely used, the S&P 500. So a large part of the run-up in the stock market is being driven by these mega stocks. And so one of the things you need to ask yourself is there price right. And now let's talk on the next slide about what a bubble is.
I know that's if you chew bubble gum, you can blow a bubble with it.
That's you could do that.
One bubble, yeah.
Yeah. So the unfortunate thing about this slide is that the bottom of the slide says that those jeans are $1,300.
Oh my gosh.
So I don't know how many pairs of those you have.
Yeah.
But that's a real ad. I just went out and I Googled jeans, the designer jeans. And you can get more expensive jeans than that.
With more rips in it.
Yeah, probably more rips the better.
Yeah, more faded.
Yeah.
so that they look really dingy. Yeah.
Yeah.
Yeah, right. And holes in the butt area. Yeah.
There you go.
Yeah.
So Greenspan, the last time we had a bubble was in the growth bubble in the late 90s. And he called that irrational exuberance. But behavioral scientists tell us that we're not irrational. Bubbles happen. And a bubble is when the price is much higher than the value, but somebody's got to tell you what the value is. I don't know about you, but to me, those jeans don't even feel close to being worth $1,300.
No.
But we all have biases, and those biases really inflate the bubble. So we have overconfidence biases, we have recentness biases, all these things that sort of cause us to want to jump on, and that a recent sort of explanation for what's going on is a bias. It's called FOMO, fear of missing out. We see things going up, and on the next slide I want to talk about that. So the market is reaching new highs. It has been until the last 4 days. And investors see that and they go, I want that. I want some of that money. I can't make any money in bonds. And it sort of reminds me, this is maybe a personal thing, but I think some people here would identify with this. I like Vegas. I think it's a lot of fun and there's great shows. And I normally go there with a budget. So let's say I have a $100 budget. And it's happened on more than one occasion where that $100 has turned into $1,000. And I sleep really good that night, and I really feel, man, I like that feeling.
Yeah. I
want more of that. And then all of a sudden, my $100 budget has become a $1,000 budget.
Yeah, because you made it more. You made
so now I'm playing with the house's money, but that wasn't my budget to begin with. And if you read books about gambling strategies, ways to get the most out of your success in gambling, it's to stop playing with the house's money. At least take some of it off the table. And I think that mentality, the Vegas mentality, is sort of going on in today's stock markets. And I'm going to talk about the millennials, but they're part of it. And they've only known a rising stock market. So they were 23 years old when in 2010 when the stock market started rising. So that all they know is every year the stock market goes up. And if it doesn't go up, it's an opportunity to buy. So the millennials are part of this. We're going to talk about other reasons. But let's see what's gone on so far this year in the market, Kath, on the next slide. So in February of this year, the market was well overpriced. And we're going to talk about what overpriced means, but it was as overpriced in February as it ever had been. And people were signaling that it's time for a correction. It's time for a correction. This has got to stop. And then it did. And the market fell down 35%. And then the discussion became, so how long is it going to take to get that back? Are we going to have a V-shaped recovery? Well, we sort of did. It wasn't quite a V, but the market has come back. And until the last 4 days, it actually come back. It was higher than it was in February, so it's more than recovered. And all that was happening, this graph on the right, while earnings were plummeting. So this overpricing thing that happened before got worse because earnings now, and the thing about what is a fair value for stocks has a lot to do with corporate earnings. You're willing to pay a little more if the earnings are good and so on, and expected to grow. But that's not the case now with the recession. So on the next slide, where people are wondering, are we going to have a V or a W or whatever? Who's doing that, Kath? Do you know?
What?
This 55 plus communities?
He says his name is Robert.
Okay. All right. So in terms of how long the recovery might last, and we did this in episode 6, the Great Depression lasted a decade, and there were 12 hits during that time period. So you might call that, I guess, 9 W's. I don't know if that's what's going to happen here, but what I do really believe is that this COVID thing is not over. The stock market has not really corrected. And the question comes up on the next slide, what is buoying up the stock market? And there's a bunch of reasons here, and I forgot to put one on here, but the important for this show, there are 78 million baby boomers who are being told to stay the course. And that course is roughly 60% in equities and 40% in bonds. If they do, that will help buoy up the stock market, but I think that's not smart. 60-40 is too much risk for baby boomers. So the other reasons are there are 92 million millennials. They don't have nearly as much money as the boomers. They've got, by my estimate, about $10 trillion, which, no, that's real money. And they have gravitated to this kinds of trading services called Robinhood, which lets them trade for free, do small trades. They've come to like what's called robo-advisors, which is automated advice. So they're getting their advice from a computer. And they are, I think, instrumental in buoying up the market. Then these FANG stocks, we're going to talk a little bit about them, are certainly buoying up the market. And the question is, how big can Amazon get? Is $2 trillion a big number or not? This is something I didn't know, but I came across this. Foreigners now are investing in the U.S. stock market like they've never done before.
Really?
Yeah. So they're representing around 16% of the stock market, which has never been the case before. And I think what's going on there is this global debt crisis is there. I think foreigners are more aware of it than we are. And they are justifiably concerned that their yen or their pounds or euros or whatever are going to be worth less. And most people don't know how to trade foreign currency. So one way to invest in the US dollar is to buy US stocks. And I think that's what's going on here is people are, foreigners are saying, I don't trust my government. I think they're going to debase the currency. My dollars are going to be worth less. I'm going to buy some US stuff. The Fed has definitely buoyed up the stock and bond markets. Started at 5, then they threw in another 3, so that's actually 8, and probably growing to 10. Investor behavior, people have written about this. Hopium is the belief that the economy is going to recover right away and be better than it was before this mess. And certainly greed is fear of missing out. The election is weighing on people's minds.
Oh my gosh, it sure is.
It's a shame we got COVID when we did. But you can't change it. We got it. So it is what it is. No, I did say the boomer thing. They should not say the course. So I want a reminder on the next slide, Kath, about what consultants are doing and what baby boomers need to be aware of. So there are 2 approaches for consultants to help their clients. One is called risk-based, and in this graph on the left, they would work with you and probably have you fill out a questionnaire. And the red curve here is what's called the efficient frontier. And that is basically mapping out the most return you can get for the risk for various portfolios. So if they can elicit from you what your risk is, they can tell you what portfolio you should do. So in this case, we model 2. What we're saying to baby boomers is that risk thing for where you are in life, in the risk zone, you cannot afford risk. So you should be having a big red line, And your consultant should be telling you, you can't go beyond this line. And that might mean that you need to lower your objectives, strive for less. But the number one objective should be to protect what you saved. You've worked all your life to save that amount of money. And if you were to lose it now, it would be catastrophic.
Yeah.
Now, later on, I'm going to talk about building an arc. So just keep that in mind. You'll see where building an arc comes in. The other approach is also should have that limit on. It's on the right-hand side. And that's the newer approach. It's called objective-based. And that's where a consultant will figure out what rate of return you need to do what you want to do, and then move that over and find the model. But be aware that if you're getting advice from a consultant, you're getting advice about models. And just be careful that you don't get brought into a model that's too risky. 60-40 is the pat answer. So on the next slide, I want to talk about the FANG stocks and what's going up the market. And this is really a cool slide. So what's going on here is the horizontal scale is the size of the company, its capitalization. And the vertical scale is the change in its price so far this year. And if you look out to the far right, you see Apple is now $2 trillion, which is incredible.
Wow.
And its stock price has gone way up. The same thing is with Amazon, Microsoft. You can read the names. Alphabet is actually Google. So the tendency has been for the mega stocks to enjoy really nice price appreciation. Part of that is probably investors going, I want to be in the market. I don't want FOMO. I don't want to miss out. So I'm going to invest in something really safe, like Apple, and that's really blowing up its price. Now, famous last words are, this has never happened before. So this phenomenon has happened before. In the 1960s, we had the Nifty 50. So in the last days before the market crashed, people were just buying these special 50 stocks. In the 1990s, we had the dot-coms. So this phenomenon is not new, but it's our 2020s version. On the next slide, I just want to put Amazon's size into perspective. Canada is the 6th largest stock market. It is $2 trillion. Amazon is the same size.
Wow.
It's as big as the entire Canadian stock market.
Wow.
And then the next slide sort of shows you how the FANG stocks have really driven the market. And so you can see the graph on the top is the price appreciation over the last 4 years of those FANG stocks, all 5 of them together, versus the S&P. And the S&P is 23% in the FANG stocks. It's hard to read the writing down on the bottom, but if the FANG stocks were not in the S&P 500, it would have appreciated by 2% less per year. Now, that might not sound like much, but it's definitely a driver. So on the next slide, I really wanted just to hone right in on it. I'm going to say, so I started this with a bubble is when prices exceed value. And I never really told you what to measure we have of value. So how do we know prices are too high? Well, I'm going to show you graphs for 2 of the popular measures. One is price earnings ratio. And the idea there is when you buy a stock, you're buying its earnings. So if that ratio, if you're paying more per dollar of earnings than you normally do, that's a pretty good indication that prices are too high. Then there's another one that Warren Buffett has introduced that I'm going to show you, but basically it's the ratio of the value of the stock market to the value of the economy, gross domestic product. And then I'm going to show you a third thing where one of these authors used 4 different measures, and they all are saying the same thing. So if you don't like those first 2, I'm going to show you a graph. Pick your measure of value, but any measure you're going to pick, there's very definitely an indication of a bubble. So
well, here's my measure of value. If I can't afford it, the price is too high.
That's a good measure. So on the next slide, it's the only thing about stocks is you can buy a half a stock or whatever. So but the price earning ratio measure here, you sort of see its peaks, and the growth bubble peak is at 43. we know what happened then. The stock market broke down 35%. That little blip that follows that basically, no, not that blip. The one just, yeah, there, anyway.
This one down here?
No, the
This
next,
one.
okay. Follow the growth bubble down.
Yeah.
Okay. Yeah. Go to the left of the 35.
Oh,
Keep going down. No, keep going down to the left. A little more to the left. Now go up. No, you passed it.
there.
Yeah, that little blurb along there is when the recovery, the economy recovered from the stock market. Price earnings ratios did not go up because the next bubble was not stocks. The bubble was housing. Okay. And then the economy went down. So price earnings ratios went down. And now it's at 35. The average price earnings ratio is 16. So right now we're looking at stocks that are at least twice as expensive as they are on average. So the other measure is Warren Buffett's measure. And that's on the next slide. And this one is in territory it's never been in before. So Warren Buffett said, if you want to see if the economy or the stock market is expensive, see how it stacks up relative to the total economy. So in the growth bubble of 2000, when that burst, that ratio was 130%. Then in the economic crisis, the housing crisis of 2007, that measure was 110%. Now it's at an unprecedented 180%.
Wow.
So another measure of overpricing. Then the next chart shows you the price earnings ratio in the upper left. Then there's another measure called price to book that was popularized by Professors Fama and French. In the lower left is the price to sales ratio, and the lower right is enterprise value to sales. And what those red things are telling you is those are all saying overpriced. So if you spend some time with these tables, what you'll see is that maybe energy stocks are not overpriced. But energy stocks have been so depressed and they're so subject to OPEC, the cartel. But everything is pretty red. So even broken out by economic sector, there's some problems. So now I want to do a drum roll, Kath, on the next slide.
Da-da-da-da.
This is something I've done before, and I just read one from a major institution about forecasting returns. And here's the thing about, I think, what most other people do when they forecast returns. The average return on the stock market over the last 90 some years has been 10% per year. And inflation has averaged around 3%. So people sometimes like to talk about the real return on stocks, the return above inflation. And that's 7%, 10% nominal, less 3% inflation. So that's 7%. So we all have our biases, behavioral scientists tell us. So most people who think about the stock market returns in the future will anchor on that, maybe the 10%, maybe anchor on the 7%, but that's the starting point. Others have used this formula, and it's when you break it down, let's just put it back up there, please, Kath, for a second.
Okay.
So Research Affiliates uses this formula, and others have too, but it is a tautology. So the returns on stock derive from three sources. You get the return from the dividend yield. You get a check, from dividends, and you participate in the earnings growth of the stock. That's why you buy it. And then there's the third thing that is mostly driven by investor behavior, and it's the price earnings expansion or contraction. Price earnings ratios go up or down. And that's entirely behavioral. And what that's really saying is sometimes investors will pay more for earnings, sometimes they'll pay less. And that really is mostly a reflection of the bubble. So I'm going to use this formula, and you're going to be surprised by what it produces. But one of the mistakes I've made in the past is I've said price earnings ratios are too high. I'm going to use an estimate that says that there's price earnings contraction. Price earnings ratios are going down. But there's a study that just came out on the next page, Kath, that gives me a place to look for future price earnings ratios. So this is Crestmont Research, and they show the range of price earnings ratios on the left. And I'm surprised it's as low as 7. I'm not surprised it's size 25 because we know right now it's 36. But when we have slower growth, which we actually had slower growth even before the pandemic, it's been on the order of 2 to 2.5%. So that range is between 5 and 17. So now I can put those 3 things into my forecaster, and that's on the next slide. And this table is saying, here's what the future returns will be with different earnings growth rates, with different future price earnings ratios. And we know the dividends are at 1.5%, so that's baked in here. But to come to the point, the green thing here, that 8%, if through some means the price earnings ratio stays the same for the next year, which I guess it could, the rate of return will be, and that's just the tautology, it will be 8%. That's just the way it will be. But if we move into the range of price earnings ratios, as Crestmont Research says they should be in a slow growth economy, 2020 is going to lose more than 50%.
Whoa.
Could lose as much as 70%, but that's pretty far out there. Now that's if that all happens in 1 year. What's more likely to happen is the move to lower price earnings ratios will be gradual, and it will happen over the next decade. If that happens, you can't see on the bottom of this, but the bottom of the slide basically says, if you keep PEs at 35 for the next decade, which would be quite a chore, you get 8%. There you go. Perfect. Thanks, Kath. You get 8% per year. If it doesn't stay there and it goes more into the range that we think brings it back in the area of fair pricing, we'll be losing 1% per year. That might not sound too bad, but go on the next picture, Kath, please. So people who are watching this show, they're getting a benefit of, I'm not just going to do stocks. On the next page, I'm going to talk to you about bond market returns for the next decade. And you see those sharks swimming around there? There's a reason for that.
Okay, want to go to the next slide?
Yes, please.
Okay.
And I see on the clock that we're running a little over our normal 45 minutes, but this is what you've been waiting for.
Okay.
So,
is this a drum roll? Dale has said that I need to practice on my drum roll, so let me do that. Thanks, Dale.
Perfect. So if we see the 1% per year loss for the 2020s, that will pretty much be like what we saw in the 2000s. And the 2000s, of course, happened because of the economic crisis that we had, the housing crisis. By the way, I think if the Fed had not stepped in with quantitative easing and so on, things would have been worse. And the 2010s probably would not have been as good as they have been. So I'm going to say something I just said to somebody the other day. So let's talk in 2030 and see if my forecasts were right.
Yeah, right. Yeah, right.
Now, the bond thing is actually a little easier. And forecasting bond returns is basically best done by looking at the yield curve. So right now, if I bought a 10-year treasury bond, I would get 0.7% per year for the next 10 years. And that is the best way to forecast bond returns for the next decade.
Okay.
So the bond forecast is 0.7%, and that's it. So I want to remind folks on the next slide, our theme is, and will continue to be, if you're 60-40 stocks bonds and you're a baby boomer, you need to rethink that. maybe it's the right risk for you, but at least give it some thought and maybe be a little more worried about it. And then I want to leave our viewers with a couple of thoughts from some really smart guys. So Warren Buffett said a lot of stuff, but I found two that I thought were appropriate for our current situation. He said, be fearful when others are greedy, and greedy when others are fearful. I think until the last 4 days, greed was really predominant. And then he said, predicting rain doesn't count. Building the ark does. And that's what, on that slide I talked about the ark. The ark for baby boomers is just be in touch that your primary objective now really needs to be protect your savings. Then the other wisdom comes from Ben Graham. And this one, by the way, from what I can see on the internet, Ben Graham said this, and I think Warren Buffett is quoting Ben Graham, but it's in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And I think what that really means is we can see bubbles, and I think we are seeing one. And the votes are basically, I'll pay whatever it costs to buy that designer jean. But in the long run, I don't think designer jeans are going to continue to be that price.
Right, yeah. But I'll continue to buy it as long as I can afford it, or I'll continue to buy it regardless.
Everybody else is buying it or whatever.
Yeah. Okay, so monkey see, monkey do.
Yeah. Then he also said abnormally good or abnormally bad conditions don't last very long, and that's true. So on the last slide, I just want to do what we do every time, Kath, is remind people that we're here to help. There's a lot of ways. If you want to do it yourself, we have A-Stage Robo. If you want consulting help, there's Glide Path. If you just Google, this is something I'm really surprised of. If you Google the Baby Boomer Investing Show, we are the top of the Google search.
Yeah, yay.
Yeah.
Yeah, that's good.
I think that's a big accomplishment. If you're a fiduciary on this call and target date funds, the smart funds are something you should look at. So we appreciate your watching this, and please tell everyone. Thank you.
Okay, well, let's see. We are done with that. So what are we going to do for the next show, Ron, and when is that?
Well, we're going to do it in 2 weeks.
Right.
But I don't know, and I think we're going to decide during this week to just see what's going on with COVID and the Supreme Court and all that, and maybe ask an expert to join us to talk about what all is going on there. And if I can pull enough together, I might do it myself, but I think an expert might be a good choice. So.
Okay, I'm going to put the slides in the comments so that for those of you that saw the slides and couldn't, maybe you were looking on your phones or something and you couldn't see it, here is the link to the slides that we just showed you.
Great.
Okay. All right. Okay, everyone. Well, thank you very much for watching. Thanks, Dale. Thanks, Robert. Thanks, everyone, for being here. And we will see you in 2 weeks.
Thanks. Bye now.